Hello, and welcome to Cherry Bekaert's Tax Services podcast, where we are going to be talking about the Virginia Pass-Through Entity Tax Election today. I'm Cathie Shaw, and I'm a partner with Cherry Bekaert's National Tax Practice with a specialization in state and local tax. And I'm joined today by Tony Konkol, an attorney in our SALT advisory practice. Hi, Tony. How are you today?
Great, Cathie. How are you?
I'm good. How's the weather where you are?
It's a beautiful, sunshiny day. I need to get out and do some yard work.
Well, I'm sure you'd much rather do a podcast than yard work, so we'll go ahead and get
Of course.
started.
Yeah. But great now that we're
Okay.
after this 4:15 hump. It's always a
Yes, that's
great
a
time.
relief. Yeah. Okay, Tony, we want to talk about Virginia's pass-through entity tax, but before that, let me provide a brief summary for those who might not be familiar with the pass-through entity tax elections. The majority of states, and Tony, I bet you know off the top of your head how many states have not enacted a
We're
pass-through
only
entity
at
tax.
5 states with an income tax on individuals that have not enacted something,
Okay, see, I
and
knew you would know
two
that.
that have not at least proposed some legislation.
Okay, so only two haven't proposed it, but we're at five that
Yeah.
have not enacted it.
We
So
got
that's a
three that at
lot.
least tried something that at least didn't go anywhere, but have tried to enact some kind of pass-through entity tax.
Yeah, so that's a lot of states then.
Yeah.
That's the majority of states by far have a pass-through entity tax election. And basically what that means in TCJA, the Federal Tax Act in 2017 had put in place a state and local tax deduction limit of what you can deduct in your itemized deductions of $10,000. So no matter if you were an S corp, you have millions and millions of dollars of income, millions of dollars of state tax, you could not deduct that state tax. But if that entity were in a C corporation form, they would be able to deduct the state tax. So you really got a disparity of a deduction between a corp and a pass-through, which is very interesting and odd anyway. I don't think that should have ever been. But the states that tend to run lean Democratic, or like New York and California, some of the other New England states that have really high tax rates, they saw this as a threat and an attack to their states because they couldn't, their residents could not deduct the tax and get a federal benefit. So in short, really the federal government was subsidizing a bit some of that, their tax in their state. So they quickly went through all kinds of different potential ideas of how to help their residents and to actually how can we change this so that it is a deduction. And the pass-through entity tax is the thing that really worked, that ended up being even a little bit of a rubber stamp from the IRS that, yeah, we think this works. And basically what it means is that if you have an S corp or pass-through entity, partnership, LLC that's treated as a partnership for federal tax purposes. In these states that offer an election, they all vary. As Tony can attest, he's kind of the in-house expert. They all vary somewhat. But you can generally make an election to treat the tax as being imposed on the pass-through entity itself as opposed to the individual. And what that little change does is that it's a tax that the entity is obligated for, so they can deduct it on their page 1, 1065 or 1120S, and it'll be netted in that K1 ordinary income amount where you get actually the deduction of all that tax. And then in order for it to make that work, then the individual owner in the state will get a credit for the tax paid at the entity level so that there's no double tax. Now, there's a lot of variations of that, but simply that's pretty much how it works. We make an election. Is California the only one right now with an opt-in, opt-out?
You could also say Arizona is one that to some degree you could have some owners in, some out.
Okay.
California, you could call it separately opting in. Arizona, it's rather everybody in by default, but an option to opt out. But one
It's
way
more
or
an
another, yeah.
optional opt-out.
Yeah, everybody else basically, if you make that election, it's going to apply to everybody who's an owner or everybody who's an individual, trust, estate, whoever the owners are that are subject to the state's personal income tax code.
And that used to be a big deal when these first came out, because we would have to look at where do these individual owners reside, because
Mm-hmm.
until all the states, or the majority of the states, adopted this legislation, the owner may not have gotten a credit in their resident state. So,
Right.
but now we've kind of worked through that. The majority of the states have the pass-through entity tax election, so the owners generally are going to get a credit or a deduction of the income from their state tax return. So I think, the majority of people that are familiar with tax and have a flow through entity, they're probably familiar with that, and they're making these elections where it makes sense. But now we have some real recent activity that is very impactful in the state of Virginia. So Tony,
Mm-hmm.
tell us about that.
Well, we had a bit of a heads up about it. So, the Virginia had passed this legislation 2022 to allow this retroactive PT election for the 2021 tax year. We just didn't know anything about how they were going to carry it out. It was in the legislation, in the statute, but it really delegated all the authority and specifics to the Department of Revenue to handle all of it. So we were, waiting around, waiting for guidelines, anything on how this is going to work. Um, all that we knew was at the very earliest that this could possibly happen, they gave the DOR, a 1 year head start from the latest date of the 2021 returns to be filed. So that ended up being at the very earliest October 15th, 2023 by statute that this could even be elected, paid for the 21 tax year. However, it wasn't until February that we actually got any guidelines on how we actually do this.
Yeah, I
So,
kept asking Tony, are those guidelines out yet? Are they out? And no, we're
well,
still waiting. Yeah.
no information there, unfortunately. So, I was hoping that when they would finally issue these, maybe they'd give us a little more runway of time to kind of compensate that, well, by statute, we could have been doing this back in October. But I
Yeah.
digress here. Yeah.
Yeah.
So the guidelines were finally issued in February. And so anybody who wants to take advantage of this retroactive 21 tax year election has until September 16th, which is a Monday, to take it. So one extra day at least.
And
But
we know that because we're planning weekends already.
yeah.
So it goes through Monday.
Yep.
Oh, and okay, so there's this limited time. So if you had a pass-through entity return that had Virginia source income, or you were a Virginia resident that was an owner of
Mhm.
pass-through entity, now for 2021, if you were profitable and there was some significant Virginia tax that you would have had to pay at the individual level, right? You could have withholding on the pass-through entity return, but then you would have had to file the Virginia return, pay all this tax in. So now for the 2021 return, we have until September 16th to do an amended return. And so how does that work? Like, is there a form they can print off the website and fill it out, or have their accounting firm go into their software? How is this all going to work?
Well, it's sort of a return or a form. It's online. So what Virginia required in general for their pass-through entity tax election is that payments and returns have to be filed electronically. So what Virginia had created is an online platform for taxpayers to file this special electing pass-through entity return who may not otherwise have access to tax software that would have these forms built in. And so they built this option to file the return. It is a special pass-through entity return that is different than the regular Virginia Form 502 pass-through entity return. This would be the 502 PTET return. So to allow anybody to file this return electronically under the rules established by the statute, they've built this platform to go in and essentially fill in with the fields and file this return. So Virginia created this. And this is for all tax years. So they already had this, available. And so for this 2021 retroactive election, that is the means in which this, and I say in air quotes, return, would be filed if you're going to make this retroactive election. Now, most taxpayers have already probably filed their regular Virginia Form 502 for the tax year. We're long since past that point. It would be taking a lot of that same information that is on that Form 502 that has already been filed, but putting it into this electing PTE return for the 21 tax year.
And that would have to be done online. So not
Correct.
necessarily a tax firm software that they fill out the form and they just electronically file it. This is different. You actually have to go online.
Correct.
And key everything in just for the 2021 year.
Right.
Because there is software that interfaces for the other years. So, okay. Right. And then Virginia election is very beneficial for Virginia owners of pass-through entities because they can, the tax base that you calculate this tax on is their entire K-1 income. So if you have a Virginia owner of a pass-through entity that files in 30 different states, they could just take their federal K-1 amount adjusted for your state modifications, but take that whole amount and include that in the Virginia tax base, calculate the tax on the whole thing. And then how do they go ahead and get that credit? Because the tax has already been paid, right, in 2021. So pass-through entity is going to have to pay it again. They're going to have to pay that tax again. For non-residents, it's apportioned Virginia income. For residents, it's all K-1 income. So then the pass-through entity is going to have to come up with that cash. And then what happens? How do you get that back? What happens to the individual?
So per the guidelines, the entity is going to issue another Schedule VK1, Virginia K1, for this retroactive, the 21 tax year election, showing that owner's amount of the PT credit for 2021. However, the guidelines state that as an administrative convenience and a way of doing it, that the taxpayer cannot go back and amend their 2021 return. The 23 tax year return is the exclusive manner vehicle for which they will claim that retroactive credit and claim a refund of any excess or apply it against their Virginia tax liability for the year. So it's you're filing another tax return for 2021. In addition to your Virginia 23 liability, you're getting 2 years worth of credits basically flushed through your 21 or 23 return at once. But yeah, within that window, basically to the resident or the owner of that pass-through entity, it is their 23 return only will be that return in which they claim that PT credit for the 21 tax year.
Yeah, so the 23 return right now is due. I think the end of this month, I think, is the due date. So if you're going to want to take this 21 retroactive election, you're going to want to extend the Virginia return as opposed to file it. You want to extend it. However, it's okay for people that have filed already because you can do an amended 23 return. But it's the 23 return you get the credit. So if you filed it already, you have to amend it. Otherwise, extend it until October. Then you can get that pass-through entity return in. Then you can take the credit. And I like that administrative convenience, though. I think it is helpful from the perspective of cash flow because the pass-through entity has to come up with all this cash and pay the tax again that was already paid in 2021. At least the taxpayer then can file their 23 return like right now and claim it. So hopefully it'll be a short window between having to pay that tax and then getting it back by the individual. Hopefully it'll be a short window. I will say, just from my own return experience, that when there is a lot of refunds coming back in the state of Virginia, they always think there's fraud involved and you have to provide all this additional information. And so if there are large amounts of refunds, I'm sure some people may encounter that. So just it doesn't mean anything was done wrong. It's just they want to make sure you're you, especially if you're claiming a refund of a really large amount. So I would just say, don't think that's going to be super quick. You're probably going to have to jump over some hurdles to have Virginia write you a check, even though they just got an inflow from the pass-through entity that paid in the tax. So so that's interesting. And Virginia is, it's difficult because it was retroactive and they didn't have the systems in place yet.
Right.
And so now we have this just weird thing, but it is an opportunity, I guess, to determine whether it makes sense. You might want to look at, what is the Virginia income per owner of the pass-through entity? How much tax, if you have a Virginia resident, just look at the income per owner. If it's a non-resident, then the apportion Virginia income, and then apply the tax rate to it. And is that enough tax? And then that tax amount basically would be your deduction on the federal return. So you would take that tax amount that you'd be able to take a credit for that pass-through entity is paying. And then it would be 37% if you're in the highest rate for federal tax. That would be your benefit. So you calculate the Virginia tax and then your federal effective rate times the Virginia tax. And that's really the benefit to determine whether the cost benefit is worth it. And then with regard to the deduction, because the tax is being paid in 2024, the liability there was no liability before 2024, right? We're just changing. Right. Okay, no, it's not the individual that's liable. Now it's the entity that's liable due to this legislative change. So that deduction for the individual is going to be on their federal 2024 return. So you're going to have cash in, cash out in 2024. But then on the federal return in 2024, you're going to have a deduction. The individual is going to have a deduction. There was a lot talked about, well, what about the refund? Does the refund have to be offset against the deduction? And then you really don't get any benefit. And, the thinking there is that the refund is going to the individual. The tax that was paid by the pass-through entity. They're two different taxpayers, right? So there hopefully won't be a problem. But I think a lot of practitioners take that viewpoint that yes, you would get the deduction. The states are obviously taking that position because they're the ones that have enacted all this for you to get the deduction. So that it's interesting. So cash in, cash out this year, and then get a federal deduction in 2024. Again, it's only worth it if you look at your federal effective tax rate times the Virginia tax for the pass-through entity deduction. And it is refundable, right? So we don't have to worry about it getting stuck there.
That is correct.
So as long as Virginia wants to cut a check. They will. It might take a little time.
It is refundable, right?
It is refundable. So it doesn't affect, so we don't have to rework other state credits or anything else, right? Because like if they have other credits in all these different areas, would those all come first so they don't have to worry about reworking any credits on their return?
Well, Virginia offers a pretty good amount of taxpayer discretion in the ordering of credits. The guidelines refer to, I believe it was a directive from dated all the way back to the 90s, but basically saying what they called structural credits have to be claimed first, and that would be like your credit for taxes paid to other states because they're usually not refundable. And then after that, well, gonna use your discretion, whatever suits you best, or whatever might be expiring first, or use those first.
And then we take this credit last.
Yeah.
And you don't have to worry about carryovers or anything. You're just going to get a check back.
Right.
So there shouldn't be
one of the last ones you'd probably want to apply. Yeah.
Exactly. Probably last if it's retroactive. So yeah. And so you get cash back. So seems easy peasy in theory. We'll see how that works. We'll see how the state system holds up on whether there are any glitches with regard to that. But if you have not talked to your preparer, you want to talk to your preparer if you have any significant tax at all in the state of Virginia for the 2021 tax year. I think we covered pretty much most of the Virginia election. Any other thoughts with regard to the election?
I mean, some of the other Virginia updates, I guess if we just want to take a holistic Virginia updates approach that may have been lost in light of this big news drop here for the retroactive PT return or PT guidelines. In January, Virginia had issued what they call their final pass-through entity guidelines. So this was following up on what they called their draft guidelines that were issued October 2022 that were really geared more towards like tax years 22 and forward. Not so much this retroactive year election, but things that were new in that that we just found out in January were for S corporations, they're allowing this optional election where if you have residents and non-residents, you can choose for residents to just compute on your Virginia sourced income of the entity. So your allocated apportioned income to Virginia rather than a resident's entire unapportioned share of income to Virginia. Only for S corporations, if you want to do it, not required, but just allowing that option to do it evenly for all shareholders of an S corporation.
And I'm thinking they might have put that provision in because of the second class of stock rule, that if you have unequal distributions for S corps, you have to equalize the distribution so you don't blow your S election. So they allowed that as maybe more of a simple approach to being safe.
My feelings about that too. You had states like Indiana allows that optional and for S corps or partnerships, but when you have residents to say, do you want to do it apportioned or entire? It's up to you. Just you decide and figure that out. States like New York, Minnesota are two states that allow the residents' entire share only for partnerships, but for S corporations, it's only apportioned. You don't have the option. But this approach here that Virginia's allowing, one, they're at least allowing as an option, which is nice. But that approach for S corporations only to do that apportion state sourced amount is, you see other states doing it, and I don't think any state just comes right out to say like this, it's because of the second class of stock issue. I think just like the federal deduction for the pass-through entity tax, a lot of states say like we're not we don't opine on the federal deduction part,
Yes, exactly.
Right? So they don't really bring that up either for the S corporation second class stock issue, but wink, wink, kind of follow along with what that might be.
Yeah, they certainly were requested to do that because they wouldn't have just sat there and said, "Oh, we'll put this optional in for S corp." So they were requested, by certain residents.
Yeah, and one other thing that came in these January guidelines was really like just more explanation, examples, and clarification that, for the owners, they have to make an addition to their taxable income for the amount of state income taxes that are deducted at the federal level, just to keep things neutral on the state side, which wasn't anything new. But with the examples, they had kind of clarified that the amount is limited to what would be deducted at the federal return, not necessarily the entire amount of credit they get in 1 year. So this could be the case of, if the entity made a payment in December and then another payment when they file the return in March, April or something, that, the individual would only have to add back whatever might be deducted for that year's federal return. And that kind of played into now with the retroactive election, and you kind of see they almost set the stage in the draft guide or the final guidelines in January, the importance of that and how that interplay may work here with the retroactive election and guidelines in February. Because Virginia did allow payments, even though they didn't have the filing mechanism in place yet. They at least had the option to make payments before the end of the calendar year for 2023. So there could just be some situations where a little bit of it was paid in 23, a little bit was paid in 24, that still, the person claiming that PTE credit would just be limited in 23 to an addition based on whatever was being deducted for federal purposes.
And that really spurs the question, would that have really been deductible for federal purposes in 23? Because if you didn't make the election yet, it's not like fixed and determinable. So you have to talk to your own tax preparer about when is the appropriate year for making, the deduction as well. You have recurring item exceptions and all that kind of thing. So you want to just get some clarification in your specific facts of when that tax is deductible. Okay, great. Well, I think we're to the end of our time here, Tony. I think that's really helpful. It's brand new, things that people
Mm.
need to be looking at right now in the state of Virginia so that they don't miss that September 16th deadline. Because as soon as that deadline passes, there's no option to get that 21 election.
Correct. No
Yeah.
extensions, no
Nothing. That's it.
exceptions. Yeah,
And so we would say, since you have to enter it on a state's website, if you're going to do it yourself, I would say start early because I guarantee there's going to be glitches here and there.
I
And you
wouldn't
want to
wait
make
until the
sure,
last minute.
we want to make sure no one waits till the last minute. That's for sure.
Yeah, especially if you have multiple owners of entering all separate owner information.
It's
Budget
a
your
lot of
time
entry.
accordingly. Yeah.
Yeah, it's a lot of keying. All right. Well, thank you, Tony, and thank you all for joining us on our podcast today. Please reach out to Cherry Bekaert, your contact there, or Tony or I, if you have questions around the Virginia pass-through entity tax election or with any state pass-through entity tax elections or other SALT matters. So we appreciate your time and we hope you have a great day.